Hello and welcome to Explain the Charts, your go-to channel for detailed market analysis. Today is November 18th, 2025, and we are taking a deep dive into the New Zealand dollar versus the US dollar, or NZDUSD. We'll start by covering the latest news shaping the sentiment around this pair. Then, we will jump straight into the charts to identify key levels, trends, and potential trade setups for the short and long term. First, let's talk about the fundamental picture, which appears to be a bit of a tug-of-war right now. On one hand, the Reserve Bank of New Zealand is widely expected to cut interest rates again this year, which is fundamentally bearish for the Kiwi dollar. However, the US dollar has been facing some selling pressure recently, providing a bit of a lift for the NZDUSD pair. News outlets are highlighting this conflict, noting that the pair is trading up and down, establishing clear support and resistance levels. Specifically, reports point to strong resistance near 0.5691. They also identify a key support zone between 0.5652 and 0.5665, which corresponds to the 100 and 200-hour moving averages. This fundamental conflict is the primary reason for the current range-bound price action we're seeing. Now, let's look at the daily chart to get the big picture. As you can see, NZDUSD has been in a significant long-term downtrend for over a year. The price fell from highs above 0.63 in late September 2024 and has been making a series of lower highs and lower lows ever since. You may notice several days with extremely long wicks, like on November 8th and 15th of last year. These represent moments of massive, almost flash crash-like volatility, underscoring the high risk in this market over the past year. These events liquidate positions aggressively and show how quickly sentiment can shift. The prevailing trend is undeniably bearish from a long-term perspective. Let's zoom in on the more recent action since the beginning of October. This view clearly shows the latest leg of the downtrend. After failing to hold above the 0.58 level in late October, the price experienced a sharp decline in early November. It found a temporary bottom around the 0.56 level on November 7th. Since that low, the price has been attempting to recover but has struggled to gain any significant bullish momentum. This brings us to the current consolidation phase, where the market is deciding its next major move. Switching over to the 1-hour chart, we can see this recent consolidation much more clearly. This is the range that the news reports were talking about. The price has been oscillating between the support area around 0.5650 and the resistance around 0.5690. The bounce from the November 14th lows, which was attributed to US dollar weakness, is visible here, but it stalled right at that resistance level. This 0.5691 area represents a significant hurdle for buyers. It aligns with the 38.2% Fibonacci retracement of the late October drop, adding to its technical importance. On the downside, the 0.5650 area has held as support multiple times in the past few days. A definitive break of this range is what traders are now waiting for. Now let's drill down even further to the 15-minute chart to see the intraday price action. Here we can see the market's indecision in real time. Price action today has been very choppy, moving back and forth within the established hourly range. The volume is moderate, suggesting neither bulls nor bears are in full control just yet. We see multiple tests of the 0.5650 to 0.5660 support area and rejections from the levels above 0.5670. This tight coiling pattern often precedes a significant breakout. Traders should be on high alert for an increase in volume and a clean break of the key range boundaries we've identified. So, what's the bullish scenario from here? For a bullish case to gain traction, we need to see a convincing break and hold above the 0.5691 resistance level on the hourly chart. A strong hourly candle closing above this level would be the first confirmation. This could be triggered by weaker than expected U.S. economic data or dovish statements from the Federal Reserve. If buyers break through, the first logical target would be the psychological 0.5700 mark. Beyond that, we could see a move to test the next resistance zone near 0.5750 and ultimately the late October highs around 0.5800. The probability of this scenario increases if we see a corresponding increase in buying volume on the breakout. Conversely, what's the bearish case? The bearish scenario aligns with the dominant long-term trend. For this to play out, sellers need to push the price below the critical support zone at 0.5650. A firm close below this level on the hourly time frame would signal that the recent bounce is over and the downtrend is resuming. Fundamentally, this could be driven by hawkish Fed commentary or the market pricing in the RBNZ's expected rate cuts more aggressively. The initial target for sellers would be the recent lows around 0.5600. If that level fails to hold, we could see an accelerated move downwards, as there isn't much significant support until much lower levels. The likelihood of this increases if the US dollar index starts showing renewed strength. To recap, NZDUSD is at a critical juncture, coiled within a tight range. The key levels to watch are the resistance at 0.5691 and the support at 0.5650. The long-term trend is bearish, which gives sellers a slight edge, but the recent US dollar weakness cannot be ignored. In the short term, I believe continued range-bound trading is the most likely scenario, with about a 60% probability, until a new catalyst emerges. I would assign a 25% chance of a bearish breakdown and a 15% chance of a bullish breakout in the next day or two without fresh news. Watch for any surprise announcements from the RBNZ or key US data releases, as these will likely dictate the direction of the break. Patience is key here. Wait for confirmation before committing to a direction. And that wraps up our analysis for NZDUSD. Thank you for joining us on Explain the Charts. Please remember that this video is for informational purposes only and should not be considered financial advice. Trading involves significant risk, and you should always conduct your own research and due diligence before making any investment decisions. Be sure to like, subscribe, and hit the notification bell to stay updated with our latest analyses.